Being a member of the Federal Reserve Board is not an easy job. Your monetary policy decisions are heavily scrutinized, while the tools at your disposal are blunt instruments rather than surgical scalpels. Today, the spotlight on the Federal Reserve is near peak intensity. In this latest edition of LPL Street View, we'll take a look at one reason why the Fed must manage its policy wind down without upsetting markets and the economy. The stakes are high, and sticking to policy landing will certainly not be easy. We believe over the past 12 years or so, investors have in part increasingly turned to the Federal Reserve with hope that central bankers will prescribe a monetary cocktail necessary to support risky asset prices. The Federal Reserve and other global central banks have been willing to oblige. The difficulty potentially arises when those central banks wish to take back the policy foundation on which asset prices have been supported. This then makes it necessary for businesses and household balance sheets, price valuations, and economic policy to stand on their own. 2022 could be a test of this very issue, as the Fed is expected to raise rates and roll down its quantitative easing program. As this chart shows, the degree of leverage employed in the U.S. economic system means the Federal Reserve must act to roll back accommodative policy without spooking holders of stocks, high-yield bonds, and other levered instruments. Investors will have to believe the economy can hold its glide path with a larger cargo of debt while the Fed's policy tailwind is being dialed back. The good news this time around is that while leverage in the U.S. economy is near an all-time high, bank capital ratios, as this chart shows, are far better than they were during the Great Financial Crisis. In fact, for systemically important financial institutions, a Tier 1 ratio of 10% is considered well capitalized. Many of these such institutions we've checked have Tier 1 ratios well over that threshold. This renewed level of stability in the banking system may leave banks with more room to soak up any debt shortfall without overly exposing their balance sheets. This could indeed be a benefit for market confidence. What does this all mean? Well, we believe a Fed policy change of direction in 2022 is going to put some pressure on risky asset prices. However, relatively strong corporate fundamentals, earnings growth, and stable household balance sheets could provide some offsetting support for stocks. Still, this year will likely not be as easy as last year, and investors will want to ensure allocations are well balanced and buffers against risky asset price volatility are well placed. At LPL Research, we believe the Fed will be a main attraction in 2022. Central bankers' ability to pull accommodation without derailing sentiment will be a primary key in keeping a floor under equity valuations. Thanks for listening, and as always, allocate wisely.